Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we turn our attention to the previously unloved but now surging area of the stock market known as value stocks. Global asset markets are made up of dozens of asset classes and millions of individual securities. Within all this, there are a few important factors that drive returns across asset classes. These factors are driven by different economic fundamentals and tend to outperform at different times. In recent years, the best performing factors have been momentum and quality, while the value factor has underperformed. A value stock is a security trading at a lower price than what the company's performance may otherwise indicate. Investors and fund managers that favour value stocks attempt to capitalise on inefficiencies in the market, since the price of the underlying equity may not match the company's performance. Value investors have been waiting for years for their stock picking style to return to favour. Now, in November, the S&P 500 Value Index jumped 14%, compared with a gain of 9.6% for its growth counterpart, with a similar outcome locally here as well. So now the question remains, is this a global rotation to value, or is the market just spinning its wheels? Here to share his thoughts on the value revival and how it may be used in our portfolio, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Jim.
And just a quick reminder that before we get started, to subscribe on YouTube and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you could take a moment to click like on the video now to help our show grow. And for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So we'll jump into the agenda for today. So we're going to kick off with what is value, cover off on and fill you up if you're not fully aware of what the value component of the stock market is. We'll then jump across to some comparisons to some other factors as well. We'll then look at what is an actual value rotation, and also the outlook for value given its recent revival in the markets. And then, of course, wrap everything up in the investment outlook and how we use these themes and also the other general themes out there in the market today in the composition of our portfolios here at Nucleus Wealth. So let's jump into it. We've got a bit of background first, Damien.
Yeah, so yeah, I've just those stats you spoke about, I've just got those up as charts for anyone who's listening in and not watching. It's just sort of showing that over the last 5 years in particular, value has really lagged the world. So it's sort of pick your levels, but it's sort of around about the 20 or 30% level, depending upon different markets and different exposures. But and this is the MSCI World Value Index, which is it's got some interesting parts in terms of its composition that I think people should really be aware of, because value itself. We'll dig into that a little bit later, but
Yeah.
but there's this real thing about whether you're saying, well, what is value, and there's this idea about this naive value, and that's the way I sort of think about it, or your sort of superficial value, and that part has performed really well over the last month, after years and years and years of just sort of terrible performance. And so I've got that there also as a sort of a heat map exposure, just with quant factors on the next slide.
Sure.
And what I'm showing here is it's the way quant people tend to look at these factors is they break them up into things that generally sort of work. So earnings quality. So if you've got high earnings quality, the idea is that you'll then outperform. If analyst expectations are improving, you'll outperform. If you a growth, you show good earnings growth, then you'll outperform. If you're very efficient with your capital, if you've got price momentum, which is basically just if the price is going up, it keeps going up. And so that's all these ones that we're looking at here. And then one of those down there is valuation. And you can sort of see from this graph, and this is sort of breaking out the year by year, of just saying, if you just look at the top quartile, so the top 20% of stocks, and compared it to the bottom 20% of stocks, and you bought one and sold the other one, what would your performance be? And so far this year, despite the last month, in terms of value, you'd be down 30%.
Wow.
And so it's that idea that, well, just we had a pretty bad market on the or certainly, the market certainly fell a lot before they bounced back, and so you would have, a lot of people, I guess, would have come in and thought, well, value should protect you, shouldn't you? If I'm buying stuff cheap and the markets are falling, then that should protect me. But the reality has been this year, no. And if you look back over the last 5 years, you can just see that quite often value is the worst or one of the worst performing sectors over that time. And looking at these two at the moment, so this is so for the US, the naive value factor is down 30%, whereas earnings quality was up 25%. So there's a 50% difference in performance just as to whether you chose to go for value or quality. So obviously, some very big differences there. And a similar story in Europe. So just to sort of, and we go through these and look at different sectors and different factors and trying to work out, what's really driving this. And you get pretty much the same story, regardless of where you look. Is that that whole value factor hasn't been good. And so and it's, I guess to sort of to steal the punchline a little bit as I start going through this. I don't think that's because value is a bad factor. Buying something cheaper than another similar asset should actually be something that defines performance.
And just on that, just quickly on that. So when you say it's cheaper, is that cheaper on a like a price to earnings sort of metric, and is that against its peers or is that against the market? So is it sort of like the market, a stock's fallen out of favor with the whole market and therefore it's good value, or is it just that some other stocks in its sector have done really well and it's sort of lagging a little bit, and hence it appears to be good value?
Well, that's right. So it's depends who's defining it. So if you go to the MSCI definition, and we'll go into that in a little bit more detail, but I think the definition's quite is very naive. It's very, very basic, and so the stocks that are falling into these categories are it can be for other reasons that aren't being captured. I think when you're a bit more discerning about value, you actually get a better result.
Right.
And especially over the last few years. But let's dig into some of these other ones, because I think that'll hopefully come out as well. So I wanted to start by just a quick overview of quant factors in general, so that for anyone who's sort of not or not sort of across that, or anyone who is and just wants a quick refresher, is that so basically they're mathematical models that are there to help generate performance. So basically what we're doing is lining up all the stocks and we're saying, okay, let's say it's capital efficiency, is we're saying which of the stocks are generating the best returns for the capital that's being invested in these companies. So if we take those and we look at all those best ones, now how do those stocks actually perform versus the ones that have got the worst efficiencies? And so sometimes it's or part of that is within sectors. So you're looking at the best, the best software companies, for example, for capital efficiency versus the worst ones. But a lot of it is actually between sectors as well. So if you're looking at, say, an industrial sector that's quite leveraged to the economy, you'll see different results come out of that than what you might to an Apple or a Facebook or one of the sort of the tech stocks that's sort of might be less exposed to the economic cycle.
Right. Yep.
So, and the idea with these quant factors is there's no one pretends they work all the time, but if they work 55-60% of the time, then over the course of a year or a couple of years, then you actually end up outperforming. And there's this the one thing that a lot of people miss is this implicit assumptions about reversions and non-reversions. And so I've got a slide just with the most common factors that people use and that you'll probably see out there, and just the idea that there's this implicit assumption behind all of these, and the implicit assumption in value is very different to every other one. So there's this factor called momentum, and basically what it is when a stock's going up, it generally keeps going up, and then when stocks are going down, they generally keep going down. And so it's a very, very simple one. It's what technical analysis effectively relies on. It's what a lot of traders relied on, and it's actually quite a successful trading strategy, except for the fact you quite often lose a lot of money in a very short period of time, and it's lots of trading.
Yep.
If you're actually on top of this, you're just trading constantly. Every day you're doing multiple amounts of trade trying to chase this one. So it's not one sort of within our portfolios we do, but it's that whole idea about saying, well, if you don't know anything about a restaurant and there seems to be a lot of people in one and not many people in the other restaurant, then probably the one with lots of people in it is better than the one with not many people in it.
Right.
So
yep.
it's a
It's
So
almost
that's
like
one.
It sounds like it's the opposite to value.
Yeah, absolutely. And there are quant managers who run both value and momentum as a sort of dual strategy.
Wow.
because they're sort of almost the opposite, and so you get a bit of a, when one's doing well, you can sort of get for the other one, and vice versa. But the idea with that one is very much that you pick up you get lots of little bits of money, but every now and again you get wiped out, and so you got to make sure that you've saved up enough and your strategy is good enough that sometimes you might feel like you're making a dollar every day, and then one day I'll lose $400, and once a year I lose $400. Going, oh, just a minute, I didn't make enough. Whereas you're making $1.50 a day, and then once a year I lose $400. It's like, okay, well I can handle that. Because as long as I've been saving my things and not sort of out there spending too much of it. Then you've got essentially momentum strategy, and it's basically assuming no mean reversion. So I'm buying a stock that's going up because I'm expecting it to go up, forever, effectively. Low volatility is a similar one. That's basically if you buy stocks that don't that where their share price doesn't vary very much, like it's they're very stable stocks, is they actually tend to outperform over the longer term. And there's a few questions about whether there's falling interest rate environments and other factors that might be special for the last 20, 30 years. But certainly this is a factor which, if you've got stocks that are more stable stocks, you're expecting them to continue to be more stable stocks. And so again, that's a strategy where you're expecting no mean reversion. Growth factors, I'm looking for stocks that are growing quite quickly in terms of earnings, and assuming that they're going to keep on growing. And then I'll jump to the last one as well, is a quality where you're looking at companies that are earning high returns on equity. They've got margins are high. A lot of this is, you get a lot of the Warren Buffettism, low debt, high moats, economic moats, that type of thing is generally come out as quality companies. And again, it's this idea that I'm buying a quality company and it's not going to turn into a low quality company. But the value is very different in that I'm buying a stock that is cheap with the expectation that it's going to go back to being more normally priced. And so it's a very different factor to most quantitative factors. And that shows up in terms of the way it performs. I've got another chart up here sort of showing when value performs and outperforms. So this is over about 30 odd years or 40 years maybe. And it's just sort of going that, look, value outperforms most of the time, but it has some pretty big periods of underperformance as well. And it's actually, I've probably picked the wrong chart to display the idea that I had here though as well is because this is over rolling 5-year periods. The idea is very much with value is, and we've seen it this month, last month in November, to the extreme, is it tends to all come at once. So you get this period where it doesn't do very well or it underperforms, and then all of a sudden within a month or 6 months or 12 months, it'll throw on this massive amounts of performance, and then you're back to this sort of gradually chipping away. It's almost the opposite of that strategy we're talking about, where you're making $1 every day, and then once a year you lose $400. You're saying, well, this is a bit the other way around, where you're losing $1 every day, and then once a year you're making $400. Or it's probably not quite as extreme as that, but it's that idea that you want to be, even though you'll be getting lots of these negative effects of, okay, it's actually not doing that well, it's not doing that well, it's not doing that well, is that if you stick and you keep the faith, is that one day it'll all come good, and all your patience will be justified. And so that's why this latest one, if you read through any sort of value managers, they spend a lot of time talking about keeping the faith, and the idea that eventually it'll all come back.
Yep. Just on that as well, actually. So obviously value's had a pretty good run in November, and I've just jumped back a slide. If you were going to sort of categorize 2020 in your experience, sort of obviously glued to the screens and watching the markets every day, what are the main factors that have had a good run sort of in 2020 as opposed to just in November with value? would you say?
Oh, okay. Yeah, I mean, so quality has been your best, and analyst expectations have been the real big ones. So the idea is that if when earnings comes under pressure, if I've got companies that have actually got quite high margins and are generating good returns on capital, then they're much less likely to turn into companies that are going to have problems. And the other thing is debt as well. Is that idea that if you've got too much debt and then you have a hit to sales, then that can be a company altering event. So say something like a Hertz or Virgin, where you're just carrying too much debt for the type of business you're in, and then this just means that your shareholders getting wiped out.
Right.
So those have been good. Growth has been a very strong one, and capital efficiency as well. So all basically, so far this year, it's been all about that whole quality. We think about all those as sort of being sort of quality type metrics, but quality and growth has been where you want to get performance this year.
Okay.
And small caps volatility measures and valuation has been poor. Right. Having said that, different sectors does make a difference between sectors. Not every sector is quite set up that way, and some of that's really about the sectors as well. So say the volatility one, within some sectors within that. So if you were in REITs, which were traditionally had quite low volatility, but so REITs, is real estate investment trusts. So if you happen to be in there and you own lots of shopping centres or residential or whatever that got hit quite hard by coronavirus, then that's that affected that volatility side. Whereas if you're in or something like an airport, again, you got hit quite hard. Whereas if you're in something a bit more stable, say some electricity utilities or something like that was a bit more stable and a bit more sort of guaranteed performance, then you actually did quite well as the interest rates fell. Okay. So some of it's the sector base that sort of gets hidden by some of these top level numbers.
Yep, sure thing. All right, thanks for that.
So I wanted to jump to the MSCI. This sort of difference between the MSCI indexes. So the idea you need to get quite. The thing I really want to impress upon people is the MSCI value index is very, very basic. It's price to book value. So whatever the accountants have said the books was worth at the last thing, it's price to earnings and dividend yield. That's it. Three measures. If you rate well on all those, then you're in the value index. If you don't, you're out. So there's no cash flow in there. Accounting standards have been changing and quite markedly over the last few years, and so book value, over the last 20 years has undergone a massive change in terms of how it gets accounted for.
Okay.
So I guess what I'm saying is, when you look at what's in there, the other switch is between service companies and manufacturers. So there's a lot of service companies out there who, or software companies who are expensing everything as they do it. So they go out and spend some money on people building software for them, and they expense it straight away. And so the balance sheet never has anything on it. So when you do a price to book on these things, they look horrendously expensive because it's like, well, you've got no assets. Yep. And we're like, well, yes, they do. They have, whatever it is, it's a Facebook or it's an Amazon or whatever it is. Its asset is it's got this it's got a website that everyone comes and visits, and so it does have some real tangible assets behind it, but they're not accounted for in a book sense.
Don't show up on the books.
Whereas if you've got a factory and some land and all that type of stuff, then you can go, oh well, I've got this book value and that's my that's sitting there. And so so the question is with MSCI indexes is, are you really capturing what value is? And I guess this is where we sort of go into a lot of different things ourselves, whereas we have a big focus on cash flow. We look at sort of we separate out what we call deep value, which is this idea of price to sales or price to book value. and we look at sort of total shareholder returns, not just dividends. So looking at buybacks and things like that.
Yep.
But I've got another slide again, and this is, I'm trying to show the naive ones rather than ours factors, just because that's what you might see elsewhere. This next slide, I've just broken out the factors that go into value. So, and yeah, these aren't all the ones that are. Sorry, there's only 3 of these that Capital IQ use, which is not Capital IQ, which MSCI use in the value index, the official value index, which is book to price, the E to P, which is earnings to price, and then dividend to price. And you can see that those 3 are the 3 that are down to 30 something percent. If you use something a bit like the top one is free cash flow to price, and you can see that's actually barely fallen at all this year.
Yep.
And then when you dig into some of the sectors, actually has been quite a good performer in some sectors. And so that idea that you actually need to be quite discerning about what value is. If you're just taking purely the value that MSCI says, then value's been a bad performer. If you're a bit more discerning about what value is, then you can get a better performance, and you can see a bit more clearly what's going on. And then the next step is saying, so that sort of falls into, what did perform really well over the last month, and really it was your banks and resources were your big ones. There were some banks and energy was the real big performance that sort of drove that outperformance, which we don't really treat as value stocks. We think within that universe, there's value versus not value within each universe. We can look at good value banks and bad value banks, and same within the energy sector. We're more concerned about good value energy stocks versus bad value energy stocks. But I think to sort of as a blanket to say, okay, that whole sector is value, or that whole sector is not value, is not the right way to look at these. Okay. And you get different accounting standards as well that sort of show up within those sectors that you won't see elsewhere.
And that sort of leads into a question there where, we sort of kicked off talking about value stocks and, a company being assessed on those various metrics. Where when you just mentioned then the, energy and banks, that's a whole collection of stocks, isn't it, under effectively under a sector. So does that mean that the sector was then treated as value as opposed to the stock being treated as value?
Well, it's a mixture of both. I mean, the stocks. What happens is this because so many. Use the energy stocks in there.
Yep.
So these guys go out and build these massive, oil rigs and spend all this money on setting up these the oil to get it into the refineries. And so they've got these huge capital values they've spent. Like Gorgon in Australia was $50-something billion worth of capital spend that they've gone and they've put that on their balance sheet as a spend. Then the oil price falls, and now people who are looking at these stocks are valuing them on, okay, how much money is this thing making versus versus its share price, and or how much cash flow, even more important, is it making versus its share price. Whereas the value mechanism saying, well, how much did they spend 3 years ago building this? Oh, they spent $55 billion. Oh, therefore the company must be worth $55 billion. And whereas analysts are going, no, they built that when it was $100 oil price, and the oil price fell to $30. So we don't care the fact they built it for $55 billion. All we care about is how much money are they going to make this over the time frame, over the next few years. And so because there were so many oil companies in that bucket, then you just end up getting a large portion of the value index, but ends up being oil companies.
All in that one, yeah. Okay.
Yeah. And something similar happens with the banks where, a lot of banks globally have been allowed to give people interest holidays or encouraged to give people interest holidays by legislation, but haven't been required to write that down as any of those down as bad debts. And so their book value is probably a bit higher than what analysts will look at the thing and say, okay, well, they say their book value is whatever, $10 billion, but I'm looking at how many people aren't paying their bills and those types of things, and maybe I only think it's going to be $9 billion or $8 billion within expectations that I have for what the write downs are really going to be. And so again, they show up as being really cheap because people are, the naive version is saying, well, you compare the value of it to how much money they've got there, but if you're not capturing what's really going on at the underlying level, and you're not capturing the earnings and the fall in interest rates and other factors, then it can look a lot better than it does, because you're just using historical measures that may not be accurate.
Okay. Well, thanks for that. Just talking about measures as well, we've had a question pop in from Hugh. He's just asking around the free cash flow to price multiple. He's asking if it's free cash flow to firm or free cash flow to equity that's used in that.
That's a very good question, and in this one, it's actually this is coming from Standard S&P.
Yep.
They tend to use free cash flow to price. We within our models we run two different ones. One is a free cash flow to enterprise value, which we think's free cash flow before paying interest payments to enterprise value, which we think's is a better way to look at it. Mm-hmm. And then we run another one, which is free cash flow to firm as well, which does include some of those interest payments. And so you're right. There's a lot of I have a lot of quibbles with a lot of exact definitions, but sometimes you can be capturing the wrong thing or capturing something you're not expecting if you don't include interest in the right way, and you're not accounting. So the free cash flow is unfortunately one of those terms as well, that there's 1,000 different definitions for it depending upon who you speak to.
Yep.
And so making sure that you're lining up.
Yeah, it pays to know you're comparing apples with apples.
Yeah. So that's sort of a bit of background to the whole value. This idea that there's been a value rotation, and there certainly has. But I guess what I'm trying to highlight as well is value, the way it's defined by MSCI, I don't think is a very good definition of value. And so it's if you just said within sectors, you said, okay, well, show me the highest value stocks versus the lowest value stocks, the outperformance hasn't been as much as what you see when you say, okay, well, if I include resources and if I include energy stocks and banks as big members of it, then then value looks a lot better in terms of its outperformance.
Okay. Jump to the trade-off.
The trade-off, that's right. I'm just showing our quality value scatograms. This is the way we invest, just to give people for anyone who hasn't looked at it. We have we put quality on one axis and then value on the other axis, and we work out what the trade-off is. So we're happy to buy a very, very high quality stock. We're happy to buy that at something that's average value or even a little bit expensive. But what we don't want to do is buy average quality stocks at average prices, or average quality stocks at expensive prices.
Yep.
Yeah. And so that's the sort of trade-off we're trying to make. But we have our own definitions of what value is and our own definitions of quality, and so they don't always line up with what markets with what MSCI will define. And MSCI, I had a few other ones in there. There's some of their quality metrics or their growth metrics. They run regressions on earnings, which we do as well. We think it's a nice way to try and work out what the trend lines are. But they're happy to run regressions on, well, they're not happy. They do run regressions on 5 periods. And for anyone with any statistical background, you usually want sort of 20 or 30 numbers at least before you want to try and yeah, exactly. Like you're running a regression on 5 periods, and you're using that to define whether a stock's going to go into an index or not. And so I think you need to the numbers that are coming out of MSCI are broadly in the right direction, but you do need to be aware that that's they have their own particular biases that are going to drive that. So so my sort of overall views for value is keeping in mind it's the idea that, yes, I do think, and I think there's a genuine case out there that if you can buy a cheaper stock rather than a more expensive stock for the same type of stock, same quality, all these other factors, then yes, you'll do better over the longer term. but it's a question of making sure you've got what is the right trade-off. It's quality. Two growth stocks that I think are going to grow at the same rate. Well, yes, I should be buying the one that's cheaper. But if it's a question between trying to compare a particularly high growth stock to a stock that's in structural decline, then if you're using value as your only measure, then to try and compare those two stocks, you're missing, the reason for the value.
Yep.
So do need to treat it very much as not as a religion,
yep.
Which sort of comes out. I think if you read any of the value newsletters, the people who strictly go only value, it sort of gets treated as a religion.
Yep.
You just have to have faith. Yes, we've had bad performance for a few years. Have faith; it'll all come good. And then those bits about just keeping in mind that it's the accounting standards have changed, and I'm not as sure as others that everything's going to be the same as what it used to be.
So Damien, when you say accounting standards have changed, do you want to just quickly run through what that means? It sounds
the biggest one for that is the biggest one for the accounting standards is the price to book. It used to be that book value would basically stay. Book value was meant to be an assessment by the management about what the right about how much goodwill was in the business, and they could write it up or down over time. And they generally there was a bias towards saying, you bought a factory and you'll depreciate that factory over time, and it'll be over a certain period of time. And then once it's
fairly standardized.
Life, that's right. But there was both an upwards and a downwards. You could write things up or down if management decided that it was worth something different, and had justification. Now there's a big push within the international financial accounting standards, and also within US GAAP, to write down, to be always looking at assets with a view to should we be writing these down to a lower value because they're no longer worth what they used to be worth. But there isn't a corresponding push to get them back. So if you go through a downturn, I bought an asset for $1 billion, coronavirus hits, and I go and write that asset down to 500 million, and then 6 months later, coronavirus comes back. So the earnings all come back, and I go, oh, okay, actually, I shouldn't have written it down to, it should be worth $1 billion again.
Yep.
It's quite hard to get that 500 back, and the accounting standards are all sort of based around, no, you've taken the write down, that's what it's worth now, and so that distorts your book value, and that's been a 15-year process or whatever, where there's that whole distortion to that. There's also a lot more buybacks than what there used to be, and buybacks tend to you issue your stock at $1, and then 20 years later you buy it back at $20 a share. Well, you actually get to wipe out a lot of your equity because you're buying it back at $20 a share and you issued it at $1.
Yep.
So there's a lot of things like that are distorting the values of distorting the book value of companies.
Sure.
That didn't used to happen.
Okay. There's always a trade-off.
Always a trade-off. Yep. So whether you want to be buying growth, whether you want to be buying quality, whatever factor you're in, having that idea that it's a trade-off. I spoke about the mean reversion. Just it's something I just want to keep every time. Got to keep remembering that value is different to other quantitative methods, and so other ones we're always looking. So if we're buying quality stocks, then what we're saying is our eyes always on what will make this stock not a quality stock, or is its quality decreasing over time, or it's not getting the same returns as it used to. That's always the big focus. Will it revert to average? Whereas value is the opposite bet, and it tends to come in spurts. And then understanding that the sectors behind it, in particular, that as I spoke about, that there are certain sectors now that are predisposed. That was the other accounting change as well. It's not quite as much of accounting change, but it's a similar type of thing. Is that service companies tend not to have high book values, whereas and there's more and more services in our economy than what there was.
That's right.
20, 30, 40 years ago.
And companies are converting to becoming service
yes.
companies over the decades as well, from memory.
Yeah. And shipping off assets. So something like a Boeing, for example, 30, 40 years ago would have made most of its parts, whereas nowadays it outsources a whole bunch of them. So, so arguably a big chunk of it, even though it's still officially sort of a manufacturing company, it's way more of a services company than what it used to be.
Okay.
Yeah.
Yep. Very good. Sorry, have you finished on this slide, or I've just got a question that's come in? Yeah, so we just had a question that's popped into the YouTube chat, and anyone that's following, please feel free to drop any questions along the way. Alex asked for the source of the scatter plot. He wants to share with a friend who likes value too much. So
right.
I think he's maybe we'll just spend just a couple of moments just talking around this scatter plot, and just as an FYI to people listening in, this is available on every holding in a client's portfolio. So this is actually taken from our client dashboard, as it were, or the portfolio teros, but obviously available on the investment team side as well. Do you want to just quickly cover off on the proponents or the contents of the scatter plot just for Alec as well, and go from there?
Yeah. So this is one we've put together ourselves. So what we've got, and this is actually from a while ago. Johnson & Johnson isn't in the same spot anymore, but it's just showing that we have sort of where Johnson is now. I run this across a whole bunch of different with different time frames as well. So all the stars are stocks within the, I think the hollow stars are stocks within the same sector, and then the full stars are stocks within the same sector and the same country. Right. And then the measures, though, are our measures of what we think value and what we think quality is. The issue is the time frame really matters as well. And so that's the other factor I spend a lot of time playing around with, especially this year more than any time, is that there's a value looking forward and saying, okay, well, if I've got a growth company and it's growing at, to Facebook or to Google or it's an Amazon, and it's growing at, 10, 20% per annum in terms of its earnings, then there's no sense in me looking back 5 years and saying, well, how much was this company worth 5 years ago? And should that mean that, should that mean I should be buying it or not? Where it's all in this growth phase, and it's about how much growth you can get through. And then there's other quite cyclical companies which will look really cheap right at the peak of the cycle. So take semiconductors as an example. They peaked out probably a year or two ago. Is that they're all trading on sort of 5 and 6 times price to earnings ratio, which is, the average is sort of 15 to 20 times. And so they looked really, really cheap, but it was because everyone was looking at these stocks and saying, well, they're making these great profits this year, but they're a very cyclical company, and they're about to make, a third of those profits next year. And so while it looked cheap on sort of this year's numbers, if you looked a few years out, it wasn't as cheap. And if you looked at the average, if you try to draw a line through the sort of middle of this sine wave cycle, it would actually look a bit expensive.
Right.
And so we've got another measure, the same scatter graph that we look at on for cyclical companies. So we can say where Apple might look really bad on that one, or Facebook might look really bad, but we get a much better feel for, say, a building material stock or something like that, as something that's quite cyclical, as to where earnings will finish up. And then you've got a future version of that, and for this year, you actually had to even throw out not some of the future versions because and go further out, because you're going, well, we know 2020 earnings are going to be bad, and earnings aren't going to bounce back in 2021 as well for some stocks, and so now we need to be looking at 2022 numbers. And when you're looking at those numbers, your confidence in how likely those numbers are coming out is pretty low. But so there's this whole trade-off between what time frame you're looking at, which measures you're looking at, how much you're weighting all of the measures, because there's some stocks that have great margins and great growth, but they're getting really bad return on capital.
Yep.
And so it's trying to work out, well, how much do I weight each of those factors in terms of it, and the timing of return on capital's key in terms of how we put together a lot of this as well. Is that if you have a stock that's say if it's an energy stock, and they've just plowed, $100 million into some research and development or exploration, or proving up reserves or whatever it is, then you can't turn around next year and expect them to get a return on that 100 million. Like, that's going to take them 5 years, and for some things, it's going to take them 20 years to get a return on it. Whereas if you've got a retailer that just plowed $100 million into opening a whole bunch of new shops, well, I want to start seeing a return next year, and the year after that, I definitely want to see a return. Because if you just spent $100 million, then show me when you're getting it back.
Yep.
And so there's a lot of time frame stuff that goes into this that we make value judgments on, and it's very difficult to do that across. You can't use the same judgment across all companies. You need some sort of sector.
Yep.
Some sector biases on it. So,
okay.
yeah.
And just finally as well, maybe just for Alec and anyone else following, it's always good to hear the explanations of the extremities of this scattergram. Maybe if we start with the top right and then move to the bottom left on, what sort of company would be sitting right out in the, expensive and poor quality and vice versa.
Yeah.
Yep.
So they tend to be the very high growth companies in the top right. So Tesla is right up there in the top right. Companies that are not making much money, and the reason for that, and it's not to say those companies are going to be bad. What it's saying is they're already priced for success, or you need to actually do a lot of company specific analysis to work out which ones of these are going to pass and which one's going to fail.
Which one's going to be the winner?
What tends to happen with growth stocks, and you probably the last few years might have confused a few people because growth stocks have done so well, is that what tends to happen is they get priced for success, but only a very small portion of them actually succeed the way they're priced.
Yep.
And so over time you tend to lose money on it, not because they don't grow, but because more growth is factored in. People get too optimistic about how fast they're going to grow. And so, so that's the one that tends to sit up there. Actually, the bottom left tends to be stocks you often don't want to buy as well, because they tend to be value traps. And so that's where we spend a bit of time going through all those, trying to work out which one of these are actually good quality and cheap, or is it just that the way financial models tend to look at these, they just look like they are. So good examples will be there'll be some biotech stocks, some healthcare stocks that'll have patents, and they're making bucket loads of money at the moment, but the patents are expiring in 5 years time. And so you might be expecting their earnings is going to halve or go down by 70% in 5 years time, but this year's earnings look great, and last year's earnings look great, and next year's earnings look great, and the year after still looks great. And so and the company's probably not investing that much. They're in the harvesting mode because they're about to.
Happy.
So cash flow is pouring in, and it's a matter of actually saying, well, will it still be good quality after this happens? And so that's where we very much I'd very much urge people to treat these quant measures as a guide. And even more so, if you're just saying that here's a stock that's in the MSCI value index or the MSCI quality index, I'd be treating that as a very loose guide and going and trying to make sure that it is truly value or it is truly quality before you bought it.
Yep. All right. No worries. Thanks for that. And hopefully that's helped Alec out. Jump across to the value outlook.
Yeah. Okay. So the question. So this is the $1 trillion question. So value's outperformed for a month. Can we get another 12 months out of it, or six or 12 months out of value? So it's now the time to be. If you didn't have value in your portfolio, should you be switching and getting value into your portfolio? So on the plus side, we're probably going to get the vaccines look highly likely now to be coming out over the next year. You're going to get this growth catch up, and you tend to find value stocks do well when earnings growth is quite good. Tends to be, it's not always the case, but often when you see good earnings growth, that's when value will outperform some of the quality or growth stocks, and value does worse when you're not seeing the earnings growth, because your average value stock is going nowhere or backwards, and for the earnings, and then you're looking over the other side of the fence, and you've got a Zoom or you've got a Microsoft or an Apple that is actually growing earnings, and then people value that a lot more than these low ones. In a period, sort of these reflation, or you've got inflation rising, tends to be a good period for value stocks.
So there's not
You've
much
got
chance of that then, given all the stimulus and next to no inflation that we've seen over the last decade.
well, there's so first one you can tick, the inflation rising. Look, I don't think it's going to happen, but there is a large portion of the market that does think it's going to happen,
Mm-hmm.
and so and certainly if you get falling into that last one, the more fiscal expenditure. So, I mean, I don't want to speculate on and I wouldn't be making a huge investment based on the back of the Georgia runoffs in the US. But basically, if Biden wins, I think that the likelihood is he'll either win both of them or neither of them.
Mm-hmm.
A split seems to be to me a very low likelihood. If he wins both of them, he has control of the Senate, and he can actually do a lot more on the fiscal expenditure. And the market's going to be worried that they're going to love that in some respects, but they're also going to be worried that that's going to start causing inflation, and that could affect value stocks. That could sort of help this whole value trade. So I don't know what the odds are. I don't think anyone knows. So the polling's basically line ball, but there's this whole thing about are people who hated Trump just going to stay home and not vote because they went there to vote against Trump?
Mm-hmm.
But then again, are people who loved Trump going to stay home because they only turned up because they wanted to vote for Trump? And so, or they're disenfranchised because Trump's told them the election was stolen, and they're like, well, my vote doesn't matter anyway, so I'll just stay home. Who knows? I don't think anyone's got any idea. But if you call it a 50-50, then there's a decent chance that if that or even 60-40 or 70-30, whichever way you want, the odds are still, there's a reasonable chance that Biden will win, or certainly a non-zero chance. And that could be a real leg up for value as well. And then the other thing is in the start or at the middle of an inventory cycle, and we are going through a global inventory cycle at the moment, is generally good for value. So the negative outlooks, if you start to see China slowing, inflation moderating, the end of the inventory cycle, and less fiscal expenditure, then that tends to be a negative outlook for value. And I guess my take on it is, of all these factors, the positive outlooks for value look like you could see them or over the next 6 to 12 months, and the negative outlooks look likely to come, but there's a window where before they start to turn. I would also say there's a big sector. The risk is not the same in all sectors. So if you're buying a value stock that's, say, a travel stock, and it's priced quite cheaply relative to what it was earning a few years ago, and you're looking at it going, okay, vaccine comes out, anyone who wants to travel is going to get a vaccine, and therefore, yes, the travel is actually going to bounce back to maybe not to 100% of where it was, but even if it bounces back to 80 or 90%, and these companies have actually gone through and wiped out their middle management, really cut costs. So quite possibly the earnings, even at 80 or 90% of sales compared to where it used to be, they might be just as profitable. That type of story, I can go. I can see less downside in one of those, subject to debt, than say a banking sector where the real risk in terms of the expansion is for me, for the banks, is when companies are allowed to go and individuals are allowed to go bankrupt. And there's two ways that can generally happen. It can be an acute version, and that was what we thought was actually going to happen at some stage, was that you would get an acute stage, and companies would start to go broke, and that can easily snowball and finish and sort of end up in an end of cycle event, or it can be chronic, where it just turns into a like the Japanese did with their companies, where they basically just bail the things out, keep throwing low price debt at them, and try not to let anyone go broke, and you just get this long period of very slow growth. And so that looks like the more likely way to us. And so at the moment, but the risk is that it can be neither way is particularly good for banks. The first one is very bad for banks. The second way ends up being bad for banks in the long term, but it can be good in the short term.
Sure.
because they don't have to write down these, and it just takes a while before those long-term returns just end up being crunched lower and lower and lower every year.
Yep.
Yeah. So I guess what I'm saying in terms of the value outlook is, you do need to very much take into account the sectors. The oil sector for me is, again, it's really dependent upon some political decisions. And so the broad outlook is, there hasn't been much oil at all used. So demand has really been hit. Going forward, you can see that as travel comes back, that'll boost demand. As people probably drive more and use less public transport, seems to be a very big trend coming out of this. So once they do actually start driving and more normalizing, quite possibly we're going to be using a lot more oil per person. The flip side is electrification of cars is increasing. Still not at levels you'd be that worried about. There hasn't been a lot of investment, so there's probably going to be a sort of bit of a supply shortage in American and sort of more developed countries. On the flip side, the OPEC countries they've been holding back on supply, and so they've actually got all this extra supply they can pump out into the market. And so there's a lot of different moving parts in that whole equation. I think we've taken a little bit of a stance. We're more bullish on it than we were, at the start of the whole crisis. But we're keeping a very close eye on that whole when to exit that trade, because there's political decision can wipe you out, or aid you, or give you lots of performance. So the risk is a lot higher within those trades. I guess where I'm getting to.
Sure. Yeah. Great. So, is there a chance that obviously just sort of casting an eye back over just the last month and this quasi rotation to value? Is it just because perhaps everything else is so bought that the market's looking for something to buy? They don't want to pay sky high prices, so they'll start dipping into value on the premise that there might be something there.
Yeah, absolutely. So well, that's the next part is need to say, isn't there? There's the idea of, okay, once I've bought equities, what am I buying within equities? And that's a different decision as to, should I be buying equities or should I be buying bonds? And so there is a certain element of that, and it's basically a normalization trade. If we think things will normalize, then the value stocks relative to, and some of these stocks relative to their counterparts are a lot cheaper. But I guess travel is a good example, or there's some industrial stocks that are quite leveraged to economic growth. In terms of they're more parts for machinery or things like that. So when everyone's out expanding and spending lots of capital, these companies do really well. But when everyone's sort of pulling back, they do poorly. And it's that idea of will those companies be able to come out as growth sort of, even though growth may not return to its previous peaks, even if it's just improving for some of those companies is enough to help them out. And so so I guess that's what keep in mind is what I've been talking about is sector positioning within an equity portfolio, as opposed to a different decision about should you own equities at all.
Over the defensive side. Just one last, actually, I'll just might drop this question in as well. Another one from Alec. Just to finish off on the value piece, the cash into passive ETFs and the cheap central bank money is money that doesn't consider value. Without discretion in purchasing, isn't value dead?
Well, look, I think there's it's an interesting argument, this one, and I've seen it from a few others circulating, that basically because people are putting money into passive, they don't care about the outcome, therefore everything gets bid up, and you don't get price discovery. I'm more of the view that what we're seeing is naive value has really been the one that's lost out over the last few years, and that a lot of it has been your definitions of value. And if you focus on something on more cash flow measures or more intra-sector measures of value, value doesn't look anywhere near as bad as what it does if you use a naive value.
Right.
Um, it's a question of price discovery in terms of saying, okay, so let's say we had 100 investors and we were all trying to pick which were the best value stocks or the best growth stocks or the best quality stocks. We're all buying and selling to each other over time, and then and you're saying, yes, we get price discovery, and then 50 of the investors give up and they just go, no, I'm just throwing it into the index, and there's only 50 people left who are still fighting over it. Well, the 50 people who own the index, they've taken out half of the stocks. So the market cap now, half of it isn't trading because these people just bought it and have left it. They're just sitting on it. And so the half that is trading, well, you're only still going to get price discovery within that. There's no, I guess what I'm saying is you've got half the number of investors, but actually you've effectively got half the amount of stock out there. So I do still think you're getting price discovery at current levels. There are people who have arguments that extend to saying you're not getting price discovery and you're not getting the liquidity that you need and other factors.
Mm-hmm.
I think that's probably true for some of the really big funds that are struggling because they haven't got as much to trade out there. But I do still think the price discovery is alive and well. I think what you'll find is there's probably a little bit more volatility as some of the big funds want to get in and get out. But that obviously creates opportunities for people who are willing to take the other side of those when they are.
Yep. Okay. Sure thing. All right, mate. We'll jump finally into our investment outlook.
Yeah. So that's that. The big overall factor I just want to come back to is we think there's a structural downturn that's lurking in the background, which is we have extreme levels of debt. For corporates, we have extreme levels of debt in some countries for households, not all. So Australia in particular has extreme levels of debt, but there are a few that have got a bit of headway, and we're getting extreme levels of debt for governments. And so how is that going to be resolved? Is this just going to be a long, slow, drawn-out process where we create zombie companies and zombie consumers who are by all sort of fundamental measures are bankrupt, but they're just not allowed to go bankrupt or given enough cheap debt that they don't go bankrupt, and then you just get this long, slow growth, or do you get this downturn? And at the moment we're looking at it, and we've sort of flipped our views to saying we thought we would have an acute shock to we're much more on the fence now. Leaning on the side that we won't get the shock of downturn, but still quite concerned we might.
Yep.
So it's about trying to get as much exposure as you can to that sort of, or as you feel comfortable with. On the flip side, valuations are a bit crazy, and certainly in some sectors. Virus is running rampant in the northern hemisphere, but I think markets are looking through that at the moment.
Or forgotten about it, or just don't care about it anymore. It's crazy.
Yeah, and I think looking through it, I think they're just saying, well, look, the vaccines there's enough vaccines here. We've got 3 with good results. That one of them will work, and there's another 3 or 4 yet to come that the companies themselves say they're getting great results, and so and are quite positive about it. So I think a vaccine seems to be it's hard to argue against at this point.
Yep.
That one of these won't be successful. And even if people, even if and I guess our argument is, even if it's only a short vaccine, so it only lasts for 3 months or 6 months, that's enough to open up travel.
Is there potential for shock in those sort of things though, where if the market's sort of pricing the vaccine success at 100%, anything under that might cause some volatility?
Look, I think the issue is there's so many vaccines out there in production,
Something will
and
work.
three that have given that. I think, whether something will work or not, there is a chance that they all fail and they all have a similar problem, or they all start causing other side effects. So there's potentially a chance that can happen, but I think the market, until proven otherwise, the market will keep going. Say one of them fails, they'll be like, oh well, we've still got 5 others that look promising, and then 2 fail, and it's like, well, we've still got 4 others that look promising, and so I think there's I think you would have to go a fair way down that route before markets would be concerned about, we only need one to work,
Yep.
and not cause side effects and that type of factor.
The other thing as well is obviously it's going to take a considerable amount of time to even vaccinate the developed world, let alone the other areas of the world.
Yes.
Is that something that's, you think, being reflected fairly in the market? It could be 18 months before everyone that wants a vaccine and can pay for it, and obviously has the ability to access it, has it there and ready to go.
Well, I think for travel stuff, I do think it's going to be along the lines of, you have a vaccine, it only lasts for 3 months or 6 months. You have a vaccine, but I'm only going to the Europe for 3 weeks or 4 weeks, or the US or whatever, and so I'm safe. And when I come back, they'll still let me in the country because I've got my vaccine. I don't have to go into quarantine.
Yep.
And I think there'll be that. I don't think it'll be mandated, but I think it'll be along the lines of, you can take your pick. If you don't want to have a vaccine, Tim, that's fine. But if you're going to Europe, then you're spending 2 weeks in quarantine when you come back, and you're paying for the hotel and the stuff like that. Yep. And that'll be enough for people to decide, well, do I want to go or not? And I do think there'll be an element of earnings surprise in some of these, in that a lot of the companies have wiped out so much of their middle management and found new efficiencies because they have to, that when sales doesn't have to bounce back to 100% of what it was in order for profits to bounce back.
Yep.
And unemployment is high still. And so there's not going to be much pressure at all on wage growth. So you'll be able to keep your wage bills low. It's a type of environment where we could see some quite reasonable profit growth.
Yep. Okay. Very good.
And the real danger is those bankruptcies. But it does seem as if, we at the start we called it suspension of capitalism. We said, that the danger is that we don't have capitalism anymore, and that's what's happened. And each successive time, so that the bankruptcies were put off for 3 months, and then they were extended to 6 months, and then most of them got extended by another 6 months to a year, and so they'll be coming up in March. I think there's a very good chance a lot of countries, especially with an eye to vaccines coming out over the following 6 or 12 months, is they'll be like, okay, well, let's just add another year to it.
Yep.
And everything will be fine by that stage. And so I think it's a problem you cannot ignore, but I do think the market's going to ignore it for the moment, and it might end up just being a chronic problem that just results in low growth for a long period of time. Yep. But while we're not seeing an acute problem where it turns into a rolling series of bankruptcies, there's better scope for returns.
Okay. All right. Very good. All right. Well, look, thanks very much for your thoughts on value, and I think that's probably it just mindful of your time as well, Damien. We can finish it up for today.
Yep.
Wonderful. All right. Thanks again. We'll jump across to our viewer question of the week. Will the rotation to value stocks last, or is the market just spinning its wheels? Feel free to drop in your answers in the comments section of the YouTube video. We can have a bit of a scroll through those and get your thoughts as well. Just also if you haven't already, feel free to click like on the video as well if you've enjoyed today. And a big thank you to all of those that have watched in live for another great episode, and of course to those who've asked some questions. And I hope you've taken away some great ideas. If you'd like to see more of our content, head over to nucleuswealth.com/content. To stay up to date with news from us, follow us on social media. And finally, if you know anyone that would get something out of today's episode, let them know about it, share with a friend, and help our show grow. So thanks again for tuning in from myself, Tim Fuller, and the team. And we look forward to catching you at the next one.